The FMCG space, Goldman Sachs is bullish on some of these names. We have the analyst with us joining us, Arnab Mitra, India Consumer Analyst at Goldman Sachs. Arnab, good morning. Good to have you with us here. Thank you for your time. Before we get into individual sort of factors at play here, we got the big macro event, which is the budget around the corner. Do you think it'll provide any help? I think Goldman has put out their budget preview note this morning. Do you think we should keep any hopes from that from the budget on the 1st of February?
Yeah, good morning. Thanks for having me on. So I think on the budget, we do expect a gradual tilt towards welfare spending, which is what our economists have put out. However, what I've seen in my experience of covering the sector for a long time is that these changes at the margin do not significantly affect consumption at a macro level. The larger factors at play, let's say last year, we had a lot of headwinds in the sector, like urban consumption slowdown. We had very sharp commodity inflation in palm oil and tea kind of commodities and very intense competitive intensity. I think our view will be to watch out for those three factors, how they change over the next 12 months. They will determine the fate of the sector in terms of how these stocks do. Government, I would say, should be slightly supportive, the government action, but I would not say that's the major, thing that we are looking at for 2025.
All right. Hi, Arnab. Good morning and good to see you, Ben. Consumer sentiment seems to be a little bit weakish, which is a bit of a worry. What are you factoring in terms of demand recovery as well as the turn of sentiment?
Yeah. So if you really look at why 2024 was a weak year for the sector, we identified three main headwinds, which we spoke about in our outlook report. The first was this urban consumption slowdown, which happened due to the combination of the very high food inflation, persistently high food inflation, and the slowdown in unsecured lending. And also remember, we had this, two Ws playing out, which is weddings plus weather. We had very, very low wedding dates for almost 8-9 months in the year, starting from the 1Q to the end of the 2Q. And we had extremely odd weather conditions where the June quarter was too hot, there was too much rain in the September quarter. So all of this came together to cause the urban consumption slowdown. So what we are seeing really is that the weddings plus weather headwind is probably behind. So we are seeing some signs of recovery in terms of retail footfalls. In the retail space. Food inflation, we do expect it to now start moderating. It was mainly driven by vegetables inflation. Our economists do believe starting from the March quarter, we will see a moderation in food inflation, and these two would be a catalyst for slight recovery. Unsecured lending slowdown probably still continues for some time, so that will continue to be a headwind, but we should be in a better place in 2025 than 24. So that's the first thing, I think, which is driving our somewhat positive stance on certain stocks. Second is, we had this extremely sharp commodity inflation, especially in palm oil and tea, and also in other commodities like coffee and cocoa. It affected specific categories like soaps, biscuits, some other foods categories, and that actually also constrains demand because you had to take very high price increases. Many of these companies had to also take margin hit in the initial period, and we are clearly seeing signs of that starting to reverse. In fact, palm oil prices have corrected nearly 15-20% from the peak in the last 1 month. So that's also driving us slightly positive in certain stocks. However, where we are still cautious is segments where there was intense competitive intensity. So paints and grocery retailing are two areas where competitive intensity has gone up dramatically because of new entrants as well as new business models like quick commerce and grocery retailing. And there we think the headwinds in 2025 will be actually more than 2024 as these disruptions increase. So we are slightly cautious on those spaces, but positive on things like QSR, where urban recovery is a big factor, and select FMCG names where the commodity moderation coupled with a slight urban pickup would be a positive factor.
Okay, so that's good to hear that you're expecting a pickup in urban consumption that could benefit areas like QSR as well. Arnab, but the other problem that some of the companies have flagged off that they're grappling with, Dabur, for example, is the change in the channel mix, with quick commerce now playing a bigger part, and we saw their update on what's happening with general trade, etc. How disruptive is this? Is this a specific issue only for some companies? And how do you see this, impacting demand and just the offtake over the course of this year?
Yeah. So quick commerce, if you really think of it fundamentally, is a new channel. How to think about any new channel is that you have modern trade, you have the conventional e-commerce, and you have quick commerce. Unlike conventional e-commerce, which has an endless aisle, and therefore the amount of options you can give to the consumer is infinite, quick commerce is still a dark store model. So you have a limited space for SKUs. And therefore, we believe quick commerce fundamentally will not shift market shares in the industry dramatically in most categories. There could be specific segments where there's a lot of new entrants, let's say beauty categories, where there could be slight fragmentation of market share. But otherwise, quick commerce is more in terms of most categories would be stable market share. The challenge that Dabur and some other companies you mentioned had highlighted was about inventory. So because quick commerce as a channel doesn't keep any inventory, while your physical retail channel keeps anywhere between 6 to 8 weeks of inventory. As the business shifts to quick commerce, there's a bit of a destocking, and that affects primary sales for a few quarters. We think it's a transitionary impact, and the impact is not very large in any case. Our expectation is anywhere between 50 to 100 bips impact because of this transition. But even that is a transitionary impact and something that's not very material for most companies to worry about.
Okay, all right, Arnab, that's a good context to keep in mind. Thank you very much for joining in today. We look forward to a longer conversation, perhaps after another couple of weeks. Thanks for joining in. That's the Goldman Sachs view on consumer expecting a pickup in urban demand going forward.